From New York City, for our viewers worldwide, I'm Katie Greifeld. Futures taking a breather after another record close. The countdown to the open starts right now. Coming up, stocks lower after closing at another all-time high. Fed speak picking back up after cooling inflation data, and investors voting in favor of Elon Musk's $56 billion pay package. We begin with the big issue, the S&P 500 notching record highs every day this week.
If you run a marathon or a race and you sprint for 7 months, which we have sprinted, let's be honest about it, you're going to be tired. And I think the market is tired here. It's, when you look at those top concentrated names, to the point they're doing extraordinarily well, right? And I'll take it. But I get under the surface, right? Whether you're pointing equal weighted, small cap, I look at some of the other sectors, they're just not participating at the same level.
Joining us now to discuss is Jay Pelosky, TPW Advisory Principal and Founder. And Jay, record high after record high. I've had about a dozen people in the past week tell me that we're due for some sort of summer pullback. And you just heard Daryl Cronk telling us that this market is tired. How are you feeling right now?
Good morning, Katie. Well, it is Friday, so, I think feeling tired is appropriate, right? But look, yeah, we've had a great run with stocks, and the U.S. has been leading the world, right? S&P up about 13% year to date. I think it's the best ever start to a presidential election year. So obviously things have been good. What I've been impressed with, though, is how well the market has been able to digest the big moves and move from overbought, to away from being overbought, as most things are, right? And now you have an opportunity. We're coming up to second quarter earnings, and earnings are what has been driving this market. It's not the Fed. It's not interest rate cuts. We switched about 6 to 9 months ago to a focus away from monetary policy to economic growth and recovery, driven in the market sense by earnings growth. And that is the story. And so to me, natural that, we take a breather maybe next week or the week after, and then we're gearing up for earnings. And earnings are likely to be good. In the second half of the year, earnings estimates have continued to be revised up through the first 5 months of the year. And so that's what the market's looking at, second half of 24 and increasingly into 25, where consensus is for double-digit earnings growth in the S&P. And that's a good environment for stocks.
So that is the fuel of this rally, that double-digit earnings growth that you mentioned. But let's talk about the Fed a little bit, because it's just been striking. You think about what we came into the year with in terms of Fed cut pricing, where we are right now. It's just been dramatic. Seems like the stock market just doesn't care. I mean, is there anything that the Fed and Jerome Powell could do at this point to stand in front of that continued rally?
Well, we've been saying for quite some time that the Fed is not the focus. The focus is on the economic recovery, what we call early cycle growth, as well as the earnings growth. And I think we've seen that just play out. So, we don't really pay a lot of attention to the dot plot. The dot plot moves all the time. It's completely data dependent, really has very little signal into the future of what the Fed is likely to do. And the market is telling you it doesn't really care whether the Fed cuts 3 times or 2 times or 1 time. It's really not important. The good news is for the market, what is important is that if we show signs of slowing, the Fed has the ability and the willingness to cut. And so the market is somewhat protected. It can go higher on earnings growth, not really multiple expansion, but it knows it has the Fed, the so-called Fed put, in its back pocket should things weaken. But there's really no sign of weakness, and nor should they be, because the economy is in full employment, real wages are growing, investment is continuing, and we'll see what happens as we get closer to the election. I think there you might have some reasons for pause as we get closer to November.
So, Jay, sit tight for just a minute. Let's get some perspective from Mike McKee, because Fed speak picking back up after officials dialed back those rate cut expectations. And Mike McKee, the blackout period is officially over. What are we expecting to hear from these Fed speakers?
Well, let me go on the record, Katie, and say that I'm tired, too, after that. Darryl Crunk's right, after this long week of the Fed, but it's not going to get any easier next week. Actually, it starts today. Shameless plug with Loretta Mester, the outgoing Cleveland Fed president, who will be sitting down with me at 1:15 this afternoon. We'll get her thoughts on where things are going and what they might do in her absence. Then next week, hold on to your hats, because just about half of the Fed is speaking, and they'll give their take on what they did last Wednesday. Harker and Cook on Monday. Then we get Barkin, Collins, Logan, Kugler, Musalam, and Goolsbee on Wednesday. Barkin comes back on Thursday. We also have retail sales on Tuesday, which will be a big number. We'll see if the consumer is hanging in there. The questions about whether they continue to spend or whether the economy is slowing. And then jobless claims suddenly became interesting on Thursday with the big jump last week. Now, the big number, though, that everybody's waiting for is going to be the week after next, when we get the PCE inflation data. Now that we've had CPI, PPI, and import prices this morning, economists are figuring out what they think PCE is going to be. And as you can see, they think it's going to be very, very low for the last month. Omer Sharif just writing in from Inflation Insights, he thinks it's going to be 0.06 on a monthly change. And basically, this just means another big drop down in the year-over-year numbers and more confidence likely for the Fed. The market, as Jay was just saying, doesn't really care, though. They've gone ahead without the Fed and started marking things down. You look at one-year inflation swaps, and basically they're falling out of bed. Right now, 2.17 is what the market thinks we're going to see 12 months from now in terms of overall inflation. This is based on the CPI. So we're going to see some pretty low numbers ahead. At least that's what the market thinks, which would suggest sooner and lower for the Fed rather than higher and longer.
All right, Mike McKee, really appreciate that. Of course, Bloomberg's chief economics and policy correspondent. And as he mentioned, don't miss Mike's interview with Cleveland Fed President Loretta Mester. That's at 1:15 p.m. Eastern. We'll catch up with Mike around the top of the hour for those UMISH numbers as well. But let's go back to Jay Pelosky, of course. And I want to talk about this age of investment that you write about in your notes, a very thoughtful June investment outlook piece. And you think about all the money that's being spent on semiconductors, on the chip industry, not just by, of course, governments, which are spending hundreds of billions of dollars, but also by some of the big tech companies. You add that all together. How do you bet against semiconductors right now?
Oh, I definitely don't. We've been long and we remain long in our model portfolios. We're big believers in what we call the pick and shovel thesis of investing in the AI age, which means the pick and shovel for digital is semiconductors, right? Everything AI related requires semiconductors. And then on the physical side, pick and shovel means the miners, because what's really exciting is the fusing of the digital in the physical spaces, the digital being AI and the physical being basically the AI factories, also known as data centers. And they are very power hungry entities. And so we have a huge combination, and this is part of the investment thesis, of the semi build out and the power build out, the fusing of the digital and the physical with the pick and shovel of semis and things like copper miners, uranium miners, et cetera. And we think this is a theme that's going to play out for the next 5 to 10 years, and it's going to help determine who wins the second half of the 2020s, which was the title of our most recent monthly. And I think it really gets down to governance, right? It's who can expand their workforce, namely immigration, which is interesting, and then who can best integrate, as you said, Katie, public and private capital at speed and with scale. And whoever is able to do that from a governing perspective, we think is going to win the second half of the 2020s.
So basically, who can seize this moment and actually execute? I do want to pick up on what you said about data centers and how investable is that theme. I think about the past week, 2 people have told me that the data center bullish thesis is a bit overblown because, like you said, this is going to play out over years and years. Maybe that if you go in right now, you're a little bit early. How are you thinking about the timelines there?
Yeah, no, that's a great question. And obviously, this is all happening at speed, right? And so we're believers that speed is accelerating. It's been a theme of ours for several years here at TPW Advisory, and the AI age just reinforces that. And I think it's a critical point to understand. The internet took 15 years to build out because every piece of it had to be created. AI is sitting on top of the internet age, and so it can be plug and play. And I think, and we think, therefore, it's going to accelerate much faster. And every country and every company needs to have AI. So there's the conversation about sovereign AI for different countries. And so for those types of reasons, we're actually adding to this thesis through the powering of the data centers and looking to invest in things that are beneficiaries of the electrification of this process. And the other thing that we're stepping into, talking a little bit about taking on risk, a little bit of a digression here, is we're actually starting to step into commercial real estate. If inflation is truly conquered in the US, if rates are coming down, we actually think it might be an interesting opportunity to step into commercial real estate here in the United States.
Well, you definitely still have to have a strong stomach to do that. But Jay, I only have about a minute left with you. We've talked, of course, about stocks. We've talked about miners. We've talked a bit about commodities. Let's talk about bonds, though. I mean, where are you when it comes to investing in fixed income right now? We've had a generational reset in yields. Is that attractive to you?
It really hasn't been, Katie. We've been overweight equities and double weighted in commodities versus our benchmark. And we're funding that through being significantly underweight fixed income and being completely out of U.S. Treasuries and developed market sovereign debt completely. And so where we've been playing is in the credit space, high yield, bank loans, emerging market debt, Asian high yield. And those are the places that we want to play because we think there's a global growth convergence, and that actually sets up opportunities in some of these segments that I mentioned that have been out of favor and therefore offering significant yields. And that's more attractive to us than Treasuries, for example. At 4.2% on the 10-year, we think growth is going to be higher than expected going forward. So we're not really all that interested.
All right, not time to take duration risk here. Jay, really enjoyed this conversation. Have a great weekend. Our thanks to Jay Pelosky, TPW Advisory Principal and Founder. And let's now take a look at the stocks moving ahead of the opening bell. We'll do that with Abigail Doolittle.
Well, Katie, we do have futures lower, but before we take a look at what's dragging, let's take a look at what is absolutely soaring, and that, of course, is Adobe. Shares are set for the best day since 2020, this after the company put up a good quarter. Importantly, though, they gave a really strong sales forecast for some of their creative products, suggesting that there is demand for their new AI products. Anything to do with AI, as you know, really creates a bit of a stir, and that is certainly happening with Adobe. As for what is dragging on futures this morning, if we take a look at both the shares of Apple and Microsoft, these big tech names are sliding a bit here in the pre-market, not for any particular reason. Apple, of course, on the week into today, up more than 8%, so a little bit of consolidation. Microsoft was down more than 1% yesterday, so that slide continuing. As for some other bigger names that are, or I should say bigger decliners, Stellantis, the company did give an update, and they are saying that it looks like at least they're losing share and struggling with an inventory pile-up. As for the shares of RH, they are absolutely plunging, down 15%. The company formerly known as Restoration Hardware, a loss of 40 cents per share versus closer to a loss of 10 cents. It seems like demand is pretty weak. Investors not liking that. Again, that stock down sharply, down 15%.
All right, Abby, thank you for that update. And coming up, presumptive GOP candidate Donald Trump is on the campaign trail.
I just want to thank the Republican Senate, and I want to thank also the House. We met, as you know, with the full House, Republican House today, and we had a tremendous meeting with them also, and there's great unity.
We'll take a look at some of his promises next. This is Bloomberg.
What's happening to our country is of great concern to the group of people standing alongside of me. We have great unity. We have great common sense. A lot of very smart people in this room and a lot of people that love our country. I just want to thank the Republican Senate, and I want to thank also the House. We met, as you know, with the full House, Republican House today, and we had a tremendous meeting with them also, and there's great unity.
And that, of course, was presumptive Republican presidential candidate Donald Trump making his pitch to top CEOs. He met with about 100 executives in Washington, including Jamie Dimon, Jane Fraser, Brian Moynihan, and Tim Cook. Now, part of Trump's plan would be to slash the U.S. corporate tax rate to 20%. That's down 1% from the current rate. And joining me now is Bloomberg's Sri Natarajan in studio, as well as Laura Davison from Washington. And let's start with you, Sri. 21% to 20%. How much does 1 percentage point actually matter here?
It's a big difference in some ways, right? Because you're talking about going from 21 to 20 might just seem like 1 percentage point, but for many of these corporations, it adds up to several hundred millions of dollars. But more important than that, it is the significance and the symbolism of it. This is Trump making a pitch to these CEOs that he will be more business friendly, much more business friendly than the current administration. He's already proved it once in Trump 1.0. The most significant achievement of that administration, at least for the corporate community, was the tax cuts that were put in place, led by Gary Cohn, of course, who went into that White House, helped champion that process, spent only less than a couple of years there, but managed to pull that off. This is Trump coming back again to these same CEOs and saying he will continue down that path. His reasoning for going from 21 to 20 is, of course, that it's a nice round number. For the CEOs in attendance, it's a nice big figure. So they're not sitting there thinking about the former president just 2 weeks out of getting a guilty verdict and therefore standing in front of them as a convicted felon. They're looking at someone who will be much better for business, possibly much better for business going forward.
It's very human, right? The focus on big round numbers. We can all relate to those figures. But tell me a little bit more about the guest list. We talked about 100 CEOs. I mentioned some of them, but who was there? Who wasn't there, Sri?
It's the Business Roundtable group. So it had some of the biggest names across the business community. You had the Apple CEO, Tim Cook. You had people like Jamie Dimon, Brian Moynihan, Jane Fraser. There were some absentees, but that wasn't like Goldman CEO David Solomon, but that wasn't necessarily because they were staging a protest against Trump. They hadn't planned on attending and they weren't there. Those who were there, of course, were part of the who's who of the corporate community. What's important about the Business Roundtable is you'll remember after the January 6th protests, the riots in 2021, this same group had come out and denounced Trump. Many of these CEOs had put out strong statements against the actions that they saw. 4 years later, that's very much in the rearview mirror. That is not something that this group is thinking about, and therefore begs the question, was it disgust with the actions 4 years ago, or was it the sense that they assumed that Trump will never be in the vicinity of Washington that allowed them to put out those strong statements back then? Because they certainly aren't bringing it up right now.
Well, let's compare and contrast here, Laura. Like Sri said, obviously Trump trying to position himself as friendlier to the corporate sector than maybe the current administration. And with that in mind, what is President Biden's approach to the private sector?
So he has been much more hands-off. He has tried to make some outroads, and even yesterday, White House Chief of Staff Jeff Zients was there to that Business Roundtable group and spoke earlier in the morning and shouted out some of the CEOs, including CEO of Walmart, that he has worked well with. But, you know, again, his tax plan is not at all the business-friendly tax plan that Donald Trump is touting. Biden rather wants to raise the corporate rate to 28%. He wants to impose taxes on wealthy Americans. A lot of the people sitting in that room would have been affected by the taxes that Biden wants. So it's a very different approach. The message that the White House has for CEOs is, look, Biden represents stability, rule of law. You're not going to have the chaos that you had of the Trump years.
Well, let's talk about one of other Donald Trump's proposals here. He also floated the idea of basically cutting income taxes as well and paying with that for tariff hikes. I mean, how viable is that strategy?
In a word, not at all. The U.S. brings in trillions of dollars of income taxes, just talking about personal income taxes here, not even talking about corporate taxes, but only, tens of billions of dollars worth of tariffs. So you would have to talk, tariffs that would quadruple, quintuple, basically make products completely unaffordable to be able to completely erase income taxes with tariffs. However, there's some things you can do on the margins, and this is something that Donald Trump and the Republicans are very much talking about doing next year, major portions of the Trump tax cuts expire, all the individual cuts, some small business cuts, estate tax cuts in 2025. So no matter who's president, whatever the makeup of Congress is, there's going to be a big tax negotiation. And that's one of the things that Republicans want to do to pay for future tax cuts.
Well, Sri, I'll give you the last word in about 30 seconds here. I would imagine that the CEOs who were in the room like tax cuts of any form, but what's the sentiment check when it comes to tariff hikes?
Well, and this is something that has been discussed, right? For a lot of these business leaders, it isn't necessarily, some of them it does matter a whole lot, but for a lot of them, it's important to know what the path ahead is, whether there are tariffs or no tariffs, or what the levels would be at. What they can't get comfortable with is the unpredictability. And that's the reason why Jeff Zients of the White House actually went out there and touted the fact that what you will get with another Biden administration is predictability, trying to remind that audience that back in the 2016 to 2020 timeframe, even if Trump was making a lot of business-friendly noises, you did live through a period of great chaos and confusion. And that is not the environment in which businesses feel comfortable making bold decisions or even comfortable with the path ahead. What they want to know is a certainty of what lies ahead of them for 4 years. And that is why the Biden administration right now is playing up that angle in their pitch.
All right, guys, great stuff. Really enjoyed this conversation. Our thanks to Bloomberg's Sridhar, Natarajan, and Laura Davison. Now, coming up, the morning calls, and later, Cameron Dawson of NewEdge Wealth joins us for the opening bell. And Meghan Swiber discusses Bank of America's latest FX and rates sentiment survey. This is Bloomberg. All right, it's time now for morning calls. A look at some of the analysts' recommendations on Wall Street this morning. And first up, JP Morgan raising Adobe to overweight. The firm sees, quote, smoother sailing ahead on new product and pricing tailwinds, as well as generative AI monetization. Next up, Evercore upgrading Shopify to outperform, saying that the recent pullback in the stock has created an attractive entry point to own a, quote, best-in-class e-commerce platform business. And finally, we have Morgan Stanley cutting Twilio to equal weight. The firm sees limited growth catalysts in the near to medium term for the communication software company. Now, coming up, we're going to be speaking to Cameron Dawson of NewEdge Wealth at the opening bell. That conversation coming up next. This is Bloomberg. This is the countdown to the open. I'm Katie Greifeld. We are moments away from the start of trading and that opening bell. You can see right now in the futures that the S&P 500 down on the day. Of course, the NASDAQ 100, your big tech stocks, the outperformer, down about 0.1% though. Small caps, the biggest loser today. The Russell 2000 off by about 1.3%. Let's take a look at the cross-market action right now. And we have dollar strength on the menu. You can see that the Euro-USD pair weakening right now. The euro trading at 106 versus the dollar. Of course, that dollar strength has been hard to stop. You take a look at the bond market. We still have a rally on our hands, only down about 2-3 basis points or so. Of course, we've had a very fierce drop in yield, so cooling off a little bit on this Friday, and crude up marginally as well. Now, one stock to watch at the open, Adobe. Shares set for their biggest gain in about 4 years after getting caught in the AI wave. Joining us now is Bloomberg's Abigail Doolittle.
It's all about that AI mentioned for sure, Katie. And as you mentioned, the best day since March of 2020. That's the degree of buying power that we're seeing, that after that big sell-off in March and then that big move higher, that's what's happening here for Adobe. Now into today, out of the December lows, down more than 30%. So investors trying to chip away at that a little bit. And it has to do with that AI, a little more certainty here. They did beat estimates for both top and bottom line estimates for the quarter that had been reported. Their new bookings, their comments around their digital media units, that is what is suggesting that the generative AI tools are seeing some meaningful adoption. Not surprisingly, the street is positive, and one acts on pretty much any stock that he covers. Mark Murphy over at JP Morgan, he has raised his rating to an overweight from a neutral, new price target of $580 per share, suggesting that there there is some meaningful upside, and the upgrade has to do with quote unquote smoother sailing ahead on new product and pricing tailwinds, generative AI monetization, and that the monetization could start to gradually build in the second half and into next year. So basically, more certainty, more stability, and a better ability to see what the numbers are like ahead. These shares up sharply in the pre-market, Katie.
Yeah, it's amazing. They're still down about 11% year to date, even with this pop, but maybe that'll change soon. Abigail Doolittle, thank you so much. Let's turn now to Tesla, because Elon Musk's $56 billion pay deal and a proposal to move Tesla's legal home to Texas won investor approval. Bloomberg's global autos editor Craig Trudell joins us now. And it seems like shareholders, at least traders, are taking this as good news.
Yeah, I think it lifts a big sort of cloud that was hanging over the stock. There weren't serious doubts that Musk was going to run into trouble with getting this signed off on, particularly with all the efforts that he was putting in, that his board was putting in. They really pulled out all the stops, but we did see a slight slip in approval for this relative to when shareholders first voted on it in 2018. The concern here, of course, was that Musk early this year referred to the idea that maybe he would want to take AI and robotics work elsewhere unless he had enough of a stake in Tesla that he feels comfortable with. This won't necessarily guarantee that he gets the stock options that were laid out for him 6 years ago, but it does bolster potentially Tesla's appeal and efforts to sort of undo the Delaware judge voiding his pay package months ago.
And maybe this will bring some of his focus back to Tesla. And Craig, not to put you on the stock here, is a refocused Elon Musk good news for Tesla?
I mean, I do think that it at least came across last night that he was very interested in speaking of robots, building that business within Tesla. That was one of the things that he talked about quite a bit. The car business, on the other hand, he wasn't really talking a whole lot about. And if anything, he was kind of, putting some emphasis on, in his words, it being tough sledding out there. And so, robots up, cars down within Tesla.
All right, robots up, cars down. Craig Trudell, thank you so much. And finally, let's turn to luxury retailer RH, tumbling after reporting a heavier than expected first quarter loss. Joining us now with more is Bloomberg's Simone Foxman.
Yeah, Katie, shares are down the most on an intraday basis since December. And the CEO, Gary Friedman, really blaming a bad housing market. Most challenging housing market, he said, in 3 decades. And he said that sales really softened for them as we saw mortgage rates tick back above 7% in the first quarter. The numbers clearly reflect that. Adjusted loss per share, 40 cents. The estimate had been 9 cents. Margins shy of estimate, though revenue roughly in line. And they kept their targets, interestingly, for the fiscal year, targeting growth in the range of 12 to 14% and revenue growth 8 to 10%. A lot of analysts, including Bloomberg Intelligence, think that may actually be pretty challenging to do. Yet, the CEO did highlight signs of positivity. They said they saw a bit of a demand inflection point in the first quarter. They also note that online retailers of luxury furniture have actually faced ceased operations, and that may improve their on the competitive front. Citi, which has a buy rating on this stock, said it's disappointing, but not game-changing. The market, however, not enthused by what they saw from RH.
Yeah, there's a lot of disappointment in those shares this morning, currently down about 14%. Bloomberg Simone Foxman, thank you so much. Meanwhile, Cameron Dawson, NewEdge Wealth CIO, weighing in on markets, writing, quote, "We think the right mantra is respect the trend," but noting that the trend could change quickly if growth forecasts begin to deteriorate for 2025 EPS or 2024 GDP. I'm pleased to say that Cameron joins me now on set. It's good to see you in person.
Good to see you.
So let's talk about what respecting the trend looks like in this market, because to me, that just sounds like being bullish on big tech.
It is being bullish on big tech just because that's where the momentum is. That's where the trend is so powerfully upward. To your point is that other sectors have really deteriorated. Look at industrials, materials, financials, energy, all areas that people had hoped would have that broadening out trade. They've given up all of their relative outperformance over the last month and a half, and you've seen a lot of absolute trend deterioration, which just means that where the momentum is, it is extraordinarily narrow, but it's hard to fight.
And so when you think about those other areas of the market, the concept that I've been turning over is whether, when we think about the performance coming back together, whether it will be a catch up for some of those other areas or a catch down for tech.
The bullish outlook would be that it would be a catch-up, and we think that really relies on earnings, where we need to see earnings revisions turn better for those sectors. They've been relatively flat, and one of the reasons why tech has done better is because it's been one of the few areas in the market that have had earnings revised higher. So it all comes down to earnings. When we think about it from an aggregate basis, we look at 2025 earnings, they do look pretty high. They're sitting at $278 a share. That's 13% earnings growth next year. So that's what we're really watching for as we go into the back half of the year, whether or not that earnings number starts to get revised lower.
So that's the thing to watch when it comes to the earnings picture. Let's talk about the economic picture, though, because you mentioned, of course, GDP and maybe some of those projections coming down. And you think about some of the data that we saw this week, and you could get a little bit concerned that maybe we're starting to see the beginnings of a growth rollover. Where do you fall?
Well, we have seen those economic surprises turn down pretty significantly over the last month and a half as well. They're actually at their lowest level since 2022, when you were aggressively cutting GDP forecasts. And yet GDP forecasts have been, through this last month or so, been relatively stable. So what we're watching for is to see if there's mounting evidence that growth is going to come in less than expected. As of yet, analysts haven't revised their forecasts. Next week, we're watching retail sales really closely. We think that's the one to even judge the jobs market. If retail sales stay strong, it means that people are likely employed, meaning we probably can trust that employment survey versus the weak household survey.
So retail sales, of course, very important, especially after that strangely blockbuster jobs print that we got last week. I mean, how did you take that?
There was so much statistical mess in it. You could look at the employment survey and say, we can't believe the number because it was all the birth and death model. But then you could look at the household survey and say, maybe we shouldn't believe that number because all of the job losses came from the 16 to 24 age range, which suggests that it's about summer jobs, college timing. So we think it's somewhere in between. Your Bloomberg economist, Anna Wong, has an estimate that it's closer to 100,000. She's been spot on, and I think that that's likely where we land, which is that somewhere in between those numbers, close to 100,000. Importantly, that's the Fed's estimate of a neutral employment market as well, which means that there's really no pressure for them to move one way or another if we do get that 100,000 in reality.
And does it matter? I mean, I was just having this conversation with Jay Pelosky, and he made the point, like you did, that it's all about earnings here. But you think about the trajectory of monetary policy. Could that upset the apple cart?
Well, it certainly has upset the apple cart for smaller cap companies and higher leverage companies. You see those earnings revisions continue to move lower. They're down in the high teens over the last year, simply because higher rates are weighing on their earnings generation capacity. For large cap companies, and mostly those big mega cap tech names, higher for longer is great for them. They earn a lot more on their cash. They don't have a big increase in interest payments. So it really is a world of haves and have-nots when it comes to how Fed policy impacts earnings.
And so good news for those big cap tech stocks. It feels like in any environment that they're going to do pretty well. But who needs rate cuts? A lot of people have told me it's the small cap companies that really need some relief here. How are you feeling about that tier of the market?
Well, small cap companies have 40% of their debt that's floating rate, and they have about in aggregate 50% more debt than what we see in overall large cap companies. So small caps really need rate cuts. You can see that by looking at last year's performance. Look back to November and December. Small caps rallied by 30% because the 10-year Treasury fell by 100 basis points. So it is absolutely necessary for small caps to outperform for there to be relief in rates. The big question is, why would you be getting relief in rates? Because if you're seeing falling rates because the economy is weakening, remember that small cap companies are also very cyclical. They have a high degree of unprofitability. Nearly 30% of small cap companies are unprofitable today, which means that if the economy weakens, maybe you get not just balance sheet pressure, but also income statement pressure.
And when I think about small caps, I often think about them and compare them to, for example, high yield debt and some of those riskier credit components. How are you thinking about the credit market right now? Of course, with this backup over the past few years that we've seen in yields?
Well, it is priced for perfection when it comes to spreads. If we look at credit spreads, they're not quite at the level of 2021 tights, but they're getting close to it. Now, overall, all-in yields are still very high because base rates are high. This is what has led demand for high yield and investment grade debt, even though spreads have been tight. So the question is, if you start questioning that growth outlook, do you see spreads widen out pretty materially? And I think that would be the risk for credit investors, mostly as we move into 2025.
All right, Cameron, it's always great to speak with you, especially on a Friday. Have a great weekend when you get there. Our thanks, of course, to Cameron Dawson, NewEdge Wealth CIO. Now, coming up, we'll take a look at Bank of America's latest FX and rates sentiment survey with Meghan Swiber, Bank of America Director of U.S. Rate Strategy. This is Bloomberg. Well, Bank of America out with its latest FX and rates sentiment survey, writing, quote, last month flagged dip buying we did not see in practice. Duration was sold on the back of NFP, inflation fears, and politics. Joining us now is Meghan Swiber, Bank of America Director of U.S. Rate Strategy. And that is so interesting because you take a look at what long end yields have done, and they've come straight down. Why are people just not enthused about duration?
So what we see from this story from our survey, and this is, again, long-only investors. So when we're thinking about who's buying in the rates market, you can still see very notable inflows into fixed income funds. That's a key here in terms of who's buying in the rates market. But what we see from this survey is that investors are just taking on a much more neutral stance on duration. Just not a lot of confidence here, which makes sense, especially when we look at this context of the huge rate move that we've observed in this past week. Maybe a bit of a feeling of the market having this motion sickness given the huge trading range that we've seen in the 10-year yield.
And so what are you telling your clients, for example, though, when it comes to how they should be thinking about duration? They're neutral right now, but we're at, 4.2% on the 10-year. I remember when we were not too long ago, close to 5%.
Exactly. So it's just been this huge rate move, Katie. And our story on duration, how we've been advising clients on this, really hasn't changed much since the start of the year. Looking to trade this range between 4 and 450 in 10s, looking to add duration when we're closer to that 5% level, above 450, and lighten up when we're at the bottom of that range. We are exactly at our forecasts for Q2 on 10-year yield, so not a strong amount of conviction and direction. But what we've seen from rates markets over the past week is really this sentiment of inflation coming back down, disinflation, which is so important for the bond market. When the bond market's not worried about upside inflation risk anymore, this does encourage a lot of buying of rates. And we usually see that rates protect you in these risk-off environments that we're seeing play out in global rates this morning.
Well, you think about what we're all competing with, and that's cash. And that's cash yields at 5%. Exactly. And I hear what you're saying about that buffer from duration, but cash also looks pretty good.
That's exactly right, Katie. And so what we've been observing is a lot of that investor demand coming into the U.S. rates market, but more of that concentrated likely in the front end and belly of the curve. Back end, we've seen that demand picture a little bit more challenged. We see a lot of the pension and insurance companies that want to be taking advantage of these high rate levels, but it's a different story. But again, when we come back to the crux of how we think about rates over longer term cycles, we have the rates market trading a much higher long-run neutral rate than what the Fed is telling us in their dot plot. So there is value there if you're worried about some of these downside states of the world and downside states of the U.S. economy.
So no one necessarily wants to take it right now, but there is an opportunity when it comes to the longer end of the yield curve. But this is the rates and FX sentiment survey. So let's talk a little bit about currencies here, because the dollar, it just feels like it's been unstoppable. How is that filtering through?
So what we're seeing, Katie, is just also similarly a moderation in some of the conviction we have in FX markets as well. You know, consistent with the very notable swings that we've seen in U.S. rates, there's been more of this paring back of the dollar longs that we had investors sitting in. Right now, I think there's actually more of this growing narrative speaking to clients of looking at more of this dollar depreciation pressure, especially in light of a Fed that's looking to cut and investors looking at rate levels and saying there may be more room for us to rally from here.
Well, I have to imagine you have to pick your spots when it comes to potential dollar depreciation. And I obviously want to talk about the yen here because it feels like nothing can really seem to stop the yen when it comes to that weakening trend.
Yeah, you know, Katie, I would say that when we look at duration positioning globally, while a lot of investors are close to home and close to benchmark, yen and yen rates is really one area that we see investors taking on much more notable positioning. So still, we see year-to-date multi-year lows, actually, in terms of how underweight investors are JGBs versus their benchmark. So when we think about the BOJ this morning kind of reining in this narrative of reducing the bond buying purchases at the back end, I think this is one of the factors that may be contributing to this rates rally that we see, is just that very stretched short positioning that we have in JGBs.
Yeah, and you take a look at where the yen is trading right now, 157 versus the dollar, just really nosebleed levels here. Let's talk about some fun stuff. Let's talk about election risk. Obviously, we got a big reminder of what that looks like when you think about India, Mexico, South Africa, and of course, France. Is there anything that investors can extrapolate from those episodes into the U.S. election?
So interestingly, when we look at the survey, we asked this question to investors: are you trading U.S. election right now? And it seems like the resounding answer is no, we're not up to that yet. We still have to pay a lot of attention to what we're seeing in terms of global elections, and really markets looking to trade and focus on the very near-term data prints. So what we're seeing, on back of the French election, a lot of the risk-off move that we're seeing this morning is concerns about what the fiscal picture looks like. Certainly that's been a concern for investors in the U.S. when we think about the extension of Trump tax cuts, what that may mean for the deficit. But largely, it's very interesting to see here, too, that this is driving more of this risk-off mentality for markets, and it's serving as more of this duration rally in U.S. rates markets, particularly. So I think it's a very conflicting signal. I think people don't have a lot of conviction in directionally what this means for U.S. rates in terms of trading U.S. election, which is just another reason why people are very hesitant to trade this theme in the U.S. just yet.
Yeah, maybe it'll become more clear, of course, as we get closer to November. I only have about 30 seconds left with you, but you think about the totality of this survey. What did respondents see as the biggest risk?
The biggest risk here is still a Fed that's going to be slower to cut rates on the back of inflation that remains more persistent. I think that really has been the dynamic that's been driving rates markets since the start of the year. The market got caught off guard by how sticky inflation had proven to be in Q1. But now we finally are seeing some of the data reflect this moderation in services, really the last shoe to drop for the Fed. So it's a very quickly changing narrative, even since we last ran the survey.
Well, Meghan, it's always great to see you. Have a great weekend. Hope to speak again soon. That, of course, is Meghan Swiber, Bank of America, Director of U.S. Rate Strategy. Now, let's get some of the sector price action this morning. We're going to do that with Bloomberg's Abigail Doolittle.
We're still looking at a small decline for the S&P 500 right now, Katie, down about 0.3%. Most of the sectors are lower, so it's a broad-based decline. Industrials leading the move to the downside, down 1.3%, followed by materials, financials, energy. To the upside, communication services up a modest 0.4%, and then tech up about 0.2%. On the week, though, it's a much different story. Tech is up more than 6%. Its best week of the year. This is the S&P 500 climbs about 1.4%. Its second up week in a row. Not a lot of sectors are up on the week, but again, that big gain for tech, and a lot of it having to do with AI. Take a look at this Bloomberg AI index, up 4.2%. We also have home building, with rates having dropped, up about 2.2%. On the downside, though, Katie, we're looking at energy sliding, and then luxury goods, speaking of that RH miss and the disappointing results there, down 3.3%. But overall, the bulls are out for a second week, Katie.
Yeah, nice even split on that screen. Abigail, thank you so much. Now, coming up, the market moving events you need to be watching. That's next in our trading diary. This is Bloomberg. Let's take a quick look at this market. The S&P 500 still in the doldrums here, down about 0.2%. I do have some good news, and that is from big tech. You can see the NASDAQ 100 made it into positive territory, up 0.2%. Can't say the same, of course, when it comes to the Russell 2000, down over 1%. It's time now, though, for the trading diary. What you need to be watching today and next week. We got U.S. UMich consumer sentiment data at the top of the hour. Meanwhile, the G7 continues in Italy. On Tuesday next week, we get U.S. retail sales. On Wednesday, the markets will be closed for the Juneteenth holiday. And then on Thursday, we get that BOE rate decision. Of course, following the Fed. It's going to be interesting to see what they do over in England. But this was the countdown to the open, and this is Bloomberg.